A wonderful good morning, ladies and gentlemen, and welcome to Naga and our first episodes of Markets for Breakfast. My name is Alex Tubadari, and I am delighted to start these daily morning calls here at Naga in order for us to go through the most important topics of the day regarding what is moving markets, where is the focus in the market happening, what are the driving factors, what are the background information for that. And without further ado, let's get started with our first episode here. Today it is Monday, the beginning of a new week. It is November the 4th, so it's also pretty much the beginning of a new month. And last Friday we had the American non-farm payroll, so the labor market numbers, and those were very, pretty much unexpectedly strong. And that combination of these labor markets to be strong, and also that there seems to be more and more a chance of the trade deal or the phase one trade deal between China and the US happening. These things are really, really helping the risk mood on the market. So that's very much the driving factor here that we have been seeing pushing stuff outward. So let's have a look at a couple of markets that could really or show that to us. So let's look at the S&P, because I want to have a look at the S&P 500, and that is typically something or a market that is very important to always have a look at. So what you can see is that we're pushing higher and higher and higher. That's actually an ETF here trading. But what I wanted to show you, and why I believe this is important information, is that because of these things really more and more now playing out, we saw that the global stocks have gained, as to Holger Chepitz here, 1.2 trillion in market cap last week, because investors are reacting to the strong US jobs report, the Fed cut. We also had last Wednesday, the US American Central Bank actually cut rates one more time for the third time in a row. Some people could argue it's a negative thing, because now we're very clearly in an easing cycle, which typically always had left to a recession in the past. Now, we are in a little bit of a different world, because we are already in a world where central banks have been on the lower end of their policy, meaning we didn't see even higher interest rates anywhere in the world other than the US a little bit. And but anyway, none of that is really right now the focus. The focus is that we've seen that these job reports and the Fed cut and the positive news on US and China are really driving markets upwards here. And coming back to these US China talks, is that we had US Commerce Secretary Ross say that, let's just pull up the S&P 500 here one more time. That they are very far along the phase one of the Chinese deal. And actually, we hear the same thing from China, saying that excuse me, that the Chinese Ministry of Commerce said we have a consensus in principle. So that is good. That is very, very good, especially since both sides are confirming it. And the likelihood that US stock markets continue to go up is pretty high. So we can also have a look at the tech companies like the Nasdaq, for example. And also, the Nasdaq has been a very good gainer recently because of that, and we can very clearly see that the pressure remains upward. So this is here on a daily, and you can see especially on Friday. So the likelihood of this to continue today, the risk on mood to continue to persist today, is relatively high, given that we see that there is consensus between China and the US. But, and I want to remind you that, yes, last week we had an article in Bloomberg, for example, that where some other Chinese officials said that they had very slim chances of that would be evolving into a phase two deal at all. So that's something we should be pretty attentive about, whether this is going to become as good as the market is playing it right now, because there's also a negative side to all these things that we really should not ignore. We had the ISM last week in the US, and only, this is what David Rosenberg is writing, that a grand total of 5 out of 18 industries posted any growth. The rest didn't. Fully 25% saw deflation and 16% saw inflation, What an economy, David Rosenberg is writing here. And he's not wrong about that. So that economy that is right now really pushing markets upwards is has a bad side to it. And the question really is that bad side enough for markets to turn negative? Well, I don't think they will right now, but there's an increasing amount of economic analysts that are really, just reading warning signs here. Also, David Rosenberg is writing, wow, what a jobs report. Fully 80% of the headline gain was part time work because of lousy biz conditions. And 100% of the NFP jump were teachers, nurses, state, local civil servants, burger flippers, bellboys, bus captains, and folks who work in waste management. So what's he saying is that because we saw that usually NFP, it comes with the headline number, meaning how many new jobs were created, but it also gives you an average hourly earnings number. And that one ticked down actually. Meaning, okay, we had more jobs, but the average earning of those more jobs was lower than before. So what we added is low paying jobs. And if low paying jobs are really driving economies upwards, that's a question that we should absolutely not ignore because usually they do not. Now, that said, what can we expect? Well, first of all, if we look at the dollar index, let's have a look at the dollar index, or we can take the euro dollar as a proxy here, for example. Euro, here we go. We can see that the euro, for example, it's not going all too far. We see it, the dollar is going lower, and I want to always look at a little bit of a bigger time frame when we get our ideas in the morning. So that is the euro, and we can see that we're pretty much stuck at this resistance level at 111.60, 111.70 almost right now. We have to push through that number. I see 112 established because even 112, as we can see in August and September, was a very contested area and eventually led to further breakdown. Now, the fair expectation for a US dollar not to continue to increase or get stronger for now because of the Fed, in my opinion, is a good one. It's not a wrong one. But the question is like, what currency is the one that can actually gain on the back of that? Because we have risk on. So the Swiss is not going to be it. The euro still has its issues, like with its own economy struggling. The pound, let's look at the pound, which is also right now not really getting a lot of love to the upside. Why not? Because it has its own situation with the new election coming now. Now, what's going to happen with this election? So we should or had needed to see the 130 really break, or at least be closed above on a daily close level yet. But this again is a 1 day chart here. So every bar is every candle is 1 day. And yeah, the pound is still quite underpriced in the big picture. But really, the question is that how strong is it? How can it continue? And it needs positive news for that to happen. We need a fundamental catalyst, and that would be, that those elections, and those elections will only be in 1 month from now. So until then, obviously, the closer we get, the more polls we get, the more volatile the pound is likely to become. But right now, I'm positive about that. The pound can try to attempt to retest the 130, but we really need to see a break above the 130 to solidify bullish ambitions here. Elsewhere, what we see if we look at the calendar this morning, we had numbers out of Australia, inflation numbers, which came in with expectations, job advertisements not as important, and retail sales came in as expected, because typically you would assume on the risk on flow, especially through the China deal, could be helpful for the oceanic currencies like the Australian dollar, like the Kiwi, meaning the the New Zealand dollar, and they have been doing good. They haven't in the recent days. And let's just pull up the Australian dollar here, so you can see that we are actually now we pushed above that 96 level. That was basically my trade when I traded the Fed release. I traded the Australian dollar breakout to the upside. Now we're limited to the 69, and again, this is an important support resistance level. It was a support here earlier in July, and if we manage to trade higher, and we can see that the numbers of today out of Australia did not disappoint. They weren't also positive, but they weren't also disappointing. So that's why we could see a continuation towards the 69.50 here in the Australian dollar trading higher. What else do we have? Well, if we look at the events today, because it's always good to get an idea what the calendar is also giving us and showing us today, we have market manufacturing out of a number of European states, and especially also out of Germany. The German economy has been hurting for a while now, like not in a positive way, what in any way you look at it, and still we see the German stock market it's relatively high compared to that. So if we get another batch of disappointing data here, that could in fact impact the euro rather lower, and maybe we could look at euro Swissy, for example, meaning we want to look at something risk on versus risk off. So a safe haven currency would be rather the Swiss franc, even though the Swiss franc is something you have to consider that if it goes too much out of hand, meaning it gets too strong, then the central bank in Switzerland likes to intervene. But nonetheless, that is an important data point that we should look for. Later in the day, you can see we have factory orders out of the US. I would also focus on these because now these days, every economic number out of the US is relevant, especially with that trade war going on. How's the impact of trade war? Listen, I mean, the ISM last week was a big blow. Like nobody expected it to be that bad. Yes, the NFP made it better, but again, the NFP was based a lot on economically less relevant jobs, and that's why I wouldn't expect the U.S. economy to really be as strong as they think they are. And remember also we had the GDP growth last week in the U.S. at only 1.9%, which Donald Trump commented on Twitter saying the best economy in the American history. It's funny because in 2012 when the GDP dropped that low, he wasn't president, and he was tweeting back then, oh, GDP just dropped to 1.9%, the economy is in deep trouble. So the same number today is the greatest economy of the American history. So you can see like how perspective is quite changing anything here. So let's see how the fundamental talks between US and China will continue. I mean, we've had that trade war cycle going on repeatedly, meaning now the hope is building up. The expectations of that phase one deal to really solidify is very firm, and if there could be a disappointment, that's probably going to see markets dip lower quite decisively. Now, because of that risk on, what we're also seeing is that gold is not really let's have a look at gold. I always like to look at gold also. This is gold versus US dollar. Is not really going down, So if the economy is so good, if the job creations are so nice, if that trade deal is so super, then why is gold still so high? Can anybody answer that? Well, the only logic explanation to that would be is that a number of market participants do believe they want and need to have gold in their portfolio. They're not interested to sell it to buy stocks, for example. So that's definitely something that should give also some alarming signs to you, as in that gold is anything but being sold off, and that should also give you a perspective on the stock market's real pricing and how good or not good it is. And also looking at oil, let's have a look at WTI here at the American oil. What we see is that even though we saw a good recovery, this is the 30-minute charts, but let's have a look at the daily chart. At the end of the week, what we saw earlier is that we dropped quite heavily towards that week, and also since October, since we had that big, you remember when the Saudi Arabian refineries were attacked, we dropped very, very steeply. Now the price, that 54 level, that's a very important support area. As you can see that we bounced off of that repeatedly, once, twice, three times, just in the recent months here, and now again. So now we are watching that 57 level right away. So if the market makes it possible to trade up to there, if there might be a rejection here, because in a nutshell, what we're seeing is that the demand for oil globally is still on the way down. People are not buying more oil because economies are not growing. So all these things tie together and really rather paint a not so beautiful picture of the foreseeable future for economic growth globally. And even though we have that optimism in the market at the moment because of the NFP number, which clearly also affected the oil price, like I said, those numbers are a little bit deceiving, and you should really put some effort into looking behind those if you are interested to understand things a little bit more. So yeah, maybe let's not also look at, last but not least, at the price of Bitcoin, which has been, since we had that huge jump after China committed to being very interested in blockchain technology. So they didn't necessarily say Bitcoin, right? But since then, we've been very much stuck to that 9,000 level. I mean, okay, technically, it's not bad where we are right now. We're holding above the 9,000. We have defended the 9,000, but we're also not seeing any real push to the upside here, which is we're stuck between a 100 and a 200-day moving average. And in a way, what they say is that it's a little bit like physics. What doesn't go up comes down, and this is something like a flag here. So if we continue to be supported at this level, and now we are getting closer and closer to a moment where we're likely to see another breakout, and if that 9,000 continues to hold, then that breakout could be to the upside. But the next bigger breakout, meaning breaking below the 9,000 or also above the 9,400, is likely to impact the next bigger move from here. So that's my overview of the markets this morning. Thank you very much for listening in. I wish you a great and a successful trading day, and we will be back here tomorrow morning. Bye bye.